Well, I got to say thank you to Ravi, Dharamshi and to Hiren Ved. Ravi, you've been kind enough with your time in the morning as well as in the evening. And Hiren Ved, where were you in the morning? I can't say thank you to you first, so I would ask you.
He was in North Block.
Markets got much more than they wanted. And yet, देखो क्या हो
Just
गया?
making sure they don't tinker with capital gains.
So no tinkering with capital gains.
Even then, Hiren, look what happened to the market. I don't know if we can just extrapolate the Nifty intraday graph.
You should have not gone to North Block straight in Bombay. Market would have not fallen.
Screen. With FIs and DIs both buying, you still had the market do what it's done. It started off 0.5% higher, 1.5% higher midday, and then it closed in the red. Why?
It's okay.
Is this on?
Yeah, we are on. We're live on air. No, what spooked the market?
Well, I think, we all know what spooked the market, right? I mean, it was the fall in the Adani Group shares, which really spooked people in terms of what's happening. And I think that was the collateral damage to the market, which I think had it not been for this, I think we would have seen the markets pretty strong enough on the budget, because the budget was fantastic. I mean, whichever way you look at it. None of the fears came true, and they delivered on everything that people were looking for. Whether it was the focus on Capex, whether it was trying to boost consumption, and who thought that they would reduce the surcharge on the highest income tax bracket, right? I mean, people said, okay, they'll do something at the lower end, help the middle class, but they've helped every class of consumer, and which is pretty thoughtful. So I think the direction of the budget is fantastic. There's no doubt about it. But obviously the sentiment got spooked by what happened with the very significant drawdown in Adani Group stocks.
So is the poison, Hiren, still not out of the system? When it comes to the Adani group of names, is there still a lot of panic amongst investors, both domestic as well as global? And are we going to see more by way of pain in the Adani names and thereby the collateral damage in the market?
So, the thing is that when something like this happens, it's like a downward spiral. You don't know what's going to stop the downward spiral, right? And then sometimes there is a price-induced selling, right? So everybody has a certain threshold of pain. Somebody can take a little bit more pain, somebody can take it little less. But if prices keep falling like this, then everybody's threshold of pain is different. But I guess, things like this should get settled. Whether it happens immediately, whether it takes a couple of weeks, we don't know. But I think largely the fabric of the market outside the group seems to be quite okay.
It takes Ravi, why is everybody worried about capital gains tax? After today's market, there will be no gains left only. After today's market, gains will not be there, so don't worry about capital gain taxes.
No, today was a graveyard for option trader, really. Seriously, I think it is a lesson one should take, not to trade in options on such volatile day. But having said that, I think from budget point of view, really there is no negative, and I completely agree with what Hiren is saying. The focus is there on continuing with the Capex cycle, continuing with incentivizing manufacturing in India. There is some added bonus in terms of incentivization for consumption, and icing on the cake, as he rightly said, is the reduction from 42% to 39% for the highest tax bracket. And not that that's a large deal or something, but it's more a signaling that, okay, it's not like we are going to keep more and more taxes on the highest tax bracket. They have other sources of funds. The tax revenues have actually surprised positively this year. So government has that leeway to not look pro-rich and yet, signal that this is the highest tax we are going to be. It will only come down, not go high.
Data which is there on your screen, if you just pay attention to it, this is how markets have moved in last 5 years. 17, 18, 19, February 2020, and after that. So in terms of a move today, it is nothing out of extraordinary. This is what the normal average move is. It's just that on such a good budget, you don't expect this kind of a move. So that brings me to my next point. Hiren, on Monday there were two concerns in the market, budget and Adani FPO. Markets have come on the right side of both the events. Adani FPO fully subscribed, budget right side.
With the marquee name.
With some marquee names.
Yeah.
That's my point. Imagine India Inc. coming together. That is just, endorsement of some kind of a
The
confidence.
creme de la creme of India Inc. Yeah.
So my question, Hiren, is, if the market is not reacting to good news, and it is still reacting to little bit of spark here and there, a whisper here and there, concerns about leverage, concerns about exposure to banking sector, and the fall is this vicious, it just exposes the underlying mood and the fabric of the market. That means markets are weak. That means the selling is intense. That means the weakness is here to stay for some more time.
I mean, could be. Look, I think sentiment can turn very quickly, right? And I think, after a point in time, I have always believed that rationality will prevail. Because if you take a perfectly good company and if there is collateral damage in the stock, at some point in time somebody will see value and say, okay, I don't want to be bothered by the noise. I see this as an opportunity, and people will come in. I think also what is happening as a result of this event is that wherever there was a little bit of overpricing, there is always a trigger where if that overpricing was going to take a much longer period of time, it probably accelerates. And we could see where there is a more than disproportionate impact of us, maybe not a horrible result, but even a slightly bad miss could have a very large impact when the sentiment is reasonably bad. But something like this also gives opportunities, right? Because people have been complaining that there are certain pockets of the market which were very expensive. And if something like this gives you an opportunity where what you like longer term is available because there is a more than disproportionate correction, then it's also an opportunity for people to get back in.
It's always a relative play, right? I mean, right now you've got China and Hong Kong markets generating a bigger alpha, and then obviously money is going to move there.
Yeah. I mean, look, I mean, a lot of people have asked me this question. So is the India story in question because of what is happening? And I said, not too far back, people were criticizing the Chinese market and the, what the policy was trying to attempt to do with the big tech companies and with the kind of restrictions that they brought in place, and people said we will never invest in China, and today everybody is rushing to China. So it's all relative, right? I mean, right now, people see an opportunity to make money in China. Fine, it's a trade people want to do, and everybody has choices. So it's okay. I mean, I don't think the India story is over by any stretch of imagination.
Is the time to add positions and build a strong portfolio base when the FIIs is sort of eluding our markets and prices are relatively more attractive to what they were even a month back?
Yeah, so I believe the fantastic rally that we had post-COVID is correcting itself, and this correction has been on since October 21. It's not as of today. It's been almost 15-16 months since we have been flattish, or there is no new wealth been created. Okay, odd sector might have done well, PSU banks or defense or something like that, but overall market capitalization hasn't really moved. Vis-a-vis that, of course, we did very well in the year 22 because the world was falling apart. So when you compare with that, it's just, I would say it's a reversal of mean that is happening in terms of relative performance. India is still doing decently well. It is still holding up. We are still within 5-7% of all-time high at index level, or even for that matter market cap level. With a 10% move, we can be again at all-time high. So I would say we are biding our time largely in a range, and as soon as we figure out that the global central banks are more worried about growth rather than being worried about inflation, the risk assets will do well, and especially India in that scenario, because India will still be one of the only major economy that is growing well. But for that to happen, the valuations have to reach a level from where you see enough juice that you should be able to see a company or a stock doubling in a 3-4 year horizon for you to get excited about it. I think it's a matter of a quarter and 5-10%, and we should be there. I don't see us facing a serious capital erosion kind of a scenario.
Now what we'll do is that we look at the 52-week change of the Nifty, and you'll be surprised that in last 52 weeks, which is last budget to this budget, the Nifty change is absolutely a flat line. There you go. It's only when you, that's 52. It's only when you look at the data you realize it.
1% down.
Yeah, I mean, just flat. That's 1 year. Now if I have to take the clock forward, I've taken the clock back. Let me take the clock forward. Same time, same year, 4 of us are chatting and discussing budget 2024. What do you think the number will look like? Anybody can say. It's a reasonable question, right?
Your 1 year Nifty target.
If you asked me last year, I would have said it would be up.
Yeah,
so if you're asking me today, I'll say it is up.
Okay.
No, I'll tell you that what is hidden between, this almost flattish Nifty is that the broader markets have corrected substantially.
Actually, the mid-cap index
We
is
all
down
know
1%.
that,
The mid-cap index in last 52 weeks is down only 1 or 2%. The small cap is down 16-17%. So that's how the data looks like.
I agree. But, the thing is that, the
2% lower.
Yeah, the larger mid-caps have done well. There is no doubt about that. The small caps is where the correction has happened. But we all know that, we've seen corrections in individual stocks ranging from 10% to 40%, right? Some have also gone up. It's not that stocks haven't gone up. So I think what is unique about the Indian markets sometimes is that if you look at it from a Nifty perspective, it looks like nothing has happened, right? But below the surface, there is a lot that happens, right? And the story is there, because unless you are an index hugging manager where you are largely buying stuff, which is very aligned to the index, you may feel that nothing has really happened. Stocks have corrected. But the reversal is also true. There are times when the index isn't doing much and individual stocks tend to do very well, right? And I think what is important from my perspective when you talked about rolling forward 1 more year is that whether the index is up 5% or 10% or 15%, to me really doesn't really matter much as the breadth of the market should improve. And I would say there is a reasonably good probability that the breadth of the market will improve. And the reason why the breadth was not so great in the last 1 year is 2 reasons. One was that we have seen compression in PE multiples as interest rates started to go up. Second, we have seen significant impact on margins for many sectors outside of financials. There actually margins have improved, but outside of financials, people have seen impact on margins, which is now slowly reversing. So in Q3, if you see, auto companies have delivered very good numbers, but there are still some sectors which are struggling with margins. Hopefully, as commodity costs roll over and as the impact of higher pricing starts to seep in, the breadth of the market, at least the earnings and the margins should come back. And if there is a sense, and we'll probably get a sense today evening or maybe 1 more rate hike down the line, if the markets get a sense that the increase in interest rates globally is kind of topping out, then the quality end of the market, where the multiples were slightly higher and which compressed, to some extent that will also come back, right? So to me, the next 1 year is not about where the Nifty is headed. I think directionally up. But for me, what is most important is where the breadth of the market is improving or not. What we don't need is typically active managers don't do well when the market becomes very narrow at the top. And typically when there are too many risk events, when the sentiment is bad, the market tends to become narrow. And then when that recedes, the breadth of the market tends to improve again. So to me, that's more important than the Nifty level.
Ravi, let's draw the correlation to the budget announcements, right? And I was just looking at it. There's higher allocation for Capex, higher allocation for defense, higher allocation for railways. Are those themes which are already now fancied by the market and well discovered, I guess, are those the themes that you've got to stick with in the longer haul?
No, I think so. I think it's a positive surprise on the allocation front. Yes, we needed the additional push for the momentum to sustain. See, the Capex cycle is being driven by central government largely till now. And we were kind of hoping that this will transition to the private players as well as the state governments going forward. But central government has actually allocated more, and in that kind of a scenario, I don't see, you are right, those stocks are trading expensive, market has identified, but there is no case for those multiples shrinking as well. So at worst there can be a time correction until multiples become attractive again, but the theme is going to continue for another 3 to 5 years clearly. And I definitely see that a year down the road we'll be actually talking about state level Capex and private Capex more than the central Capex.
Which was supposed to be the next sunrise sector, especially after the success of private banks. In last 3-4 budgets, it has been on the receiving end. 3 budgets ago, some exemptions were taken out. Today, now furthermore exemptions are taken out. Now, we can argue about the big picture, the need for insurance, Indian insurance sector under-penetrated. Why is this sector getting a stepmotherly treatment? And what do you think one should do for those who own, let's say, an LIC or a Star Health, ICICI Lombard, HDFC Life, SBI Life?
So, first of all, we don't have an exposure to that sector, but no insurance, right? I mean, broadly. Having said that, I think if you look at what the government is trying to signal, is that there was this tax kavach that the insurance sector had got. And what the government is saying is that, we don't want to give an extra, we don't want people to buy insurance because there is a tax arbitrage. So they want to take the tax arbitrage out. And they haven't done anything to term insurance, for example, right? So there was a lot of par and non-par policies that were being sold. And there was an arbitrage, right, where you were guaranteed a certain rate of yield, and you also had a tax break, so it became very, very palatable to put money there. My sense is that this power will go back to the debt mutual funds, right? Because so I think what the government is trying to do is that wherever there are arbitrages, MLD also, I think somebody had talked about it earlier on. Wherever there is an arbitrage and people are using that, I think the government wants to kind of do away with it. I don't think that changes the long-term structural story that insurance has to grow in this country. I don't think that's going to go away. But exemptions, arbitrages, I think it's time that we move away from all of those. And I think that's what the stock prices are reflecting today. So, I mean, I think HDFC Insurance, life insurance came and said that their top line impact is 10 to 12%, but the bottom line impact is 5%, right? And I think, all of them are fairly high quality, mature companies, so they'll figure out a way how to kind of deal with something like this.
Ravi, now let's look at a list. Let's call it Ravi Dharamshi's list. Stocks which you always wanted to buy, but are now suddenly looking attractive. Stocks which you're buying irrespective of what the fall in the market is, and stocks of themes which you're waiting to buy, but you will buy still at lower levels.
Unfortunately, I will not be able to name any of those.
Give me a theme, give me a sense of what you're looking at.
I think there is some distress valuation emerging, nothing to do with the budget, but there are some consumer-oriented stocks which are not reporting good numbers, where the valuations are at a 6-7 year low. Usually, if you look at a company when stock price is trading, let's say 8-10 year kind of a low, is a good time to start evaluating. You know, a lot of the bad news would be in the price. The tired bulls would be out, and I'm sure you can figure out which stocks I'm talking about. So there are, so along with the fact that there,
No, you can figure out.
so there is a pizza company, there is a liquor company, which are kind of facing issues. So the point I was making is that there is a pressure on the P&L. Balance sheets are not an issue at all. As Hiren pointed out earlier, there are margin issues that these companies are facing. So if you ever wanted to own these quality franchise, there are some distress valuations emerging. I'm not saying go ahead and buy tomorrow, but these are something that I would keep on my radar to evaluate from entering at some point in the next 12 months, I would say.
Where are you scouting opportunities after this 5% fall in the index, and even bigger for the broader market?
No, I think, look, none of these events, frankly, significantly alter our allocations, right?
Of budget.
Yeah, I mean, even X of budget, right? I mean, I think...
pizza and a liquor company. So there are food companies also, food delivery companies also, which have become cheap. It's an extension of what you pretty much are discussing.
Snacks too.
Yeah, I think the only hated area of the market is the so-called new age companies, right? You know, again, it's a tricky one, but I think they are all now somewhere close to where you could start considering them. And then you will always find...
Hiren, that's a long list of everything from an
Yeah, but
to a
we're not
Zomato to a
interested.
Paytm.
We're not interested in the long list. In that long list, even if you can get one of them, it's fine. But again, you know, jokes apart, I think. I mean, I think in terms of, for example, we were bullish on tech. We continue to be bullish on tech. I think outside of ER&D, where we already have exposure, we think that there are some good quality mid-cap tech companies which may have bottomed out now. So we've already started looking at the non-ER&D tech companies where we think there could be an interesting play. And by and large, most of these companies, the worst seems to have been priced in. Also, incrementally, it is not looking like that Europe and US will go into a terrible recession. In fact, very interestingly, if you look at most tech companies, the IT service companies, Europe as a geography has actually done better this quarter, right? Which kind of plays into the fact that the greater the distress at the macro level, the greater the need to outsource and improve productivity. So I think that's one area. Now in this, if we do get, we have some exposure to cap goods, but if we do get something a little more cheaper, we are happy to look at that. Consumer, we are already there in, you know, we've been sitting with the liquor bottle for quite a while now, hoping to, but
That sounds.
but I think that's...
Pizza along with it.
Huh?
You can buy pizza along with it.
Yeah, we'll see. We'll see. But I think some of those areas, you know, where there is a P&L issue and they have disappointed the market and there is a disproportionate move in the stock price, we would certainly use that weakness as an opportunity to start buying.
Hiren, have we reached that point in the market right now when bulls are getting fatigued with all the panic and the stress around?
I think so. I mean, again, no. I mean, there is no one homogeneous bull, right? I mean, I think the mode that people were in during COVID, where you could buy and within a quarter, 2 quarters you could make very good money. That's over and done. And I think maybe those, trying to find easy money trading, even on a short to medium term, has not been easy at all, right? So maybe now people will kind of give up and say, I think we are back to the good old days, as Rakesh ji used to say, dukh, dard aur samay ke siva paisa nahi banta. We are back to those days, back to the grind, no easy money. You got to do your work, you got to buy, have the conviction, sit through. If you are lucky, you get a lift off, but if not, you have to, kind of stay invested before you start making money. So I think we are back to the grind, we are back to the normal markets. There's no easy pickings.
It's not BTST, which is buy today, sell tomorrow. It is not QTST, which is quarter se quarter tak. It is now year se year tak. That is what we should focus on. So well, today's market unfortunately has left this, bitter aftertaste, and that's because when you got such a good budget, a budget like never before, you expected the market to salute the budget rather than get nervous with the entire, technical factor. But markets are markets, and that's what you got to do.
Tomorrow's another day, and tomorrow morning we'll have the Fed outcome as well to react to. So thank you, Hiren, as well as Ravi, for taking the time out and analyzing what the markets made of the budget today.